A very good morning, friends. The weather is pretty good today. I see, beautiful weather today, and I think we're going to replicate that weather out here in the class as well. So it's raining outside, but not a very heavy rain. It's a lighter kind of a rain with a very cool kind of a breeze which is going on. Okay, so that, if you look at the weather, one doesn't feel too encouraged in terms of studying, but I think the show must go on. So I hope that you've all made a revision of what we covered yesterday, because I give you a base in terms of how the consolidation process is done under Ind AS 110, and I'd given you a total of 6-step model which we will follow for the purpose of consolidation. Just to remind you quickly, these steps which we identified for consolidation, the step one is pretty easy, where you just need to get the acquisition date and the percentage. In terms of step number two, you need to be cautious that there are 2 steps in step number 2. So I think you'll remember the second step has got 2 sub-steps. So the first one is that we need an analysis of other equity, which I'm yet to elaborate with a practical example. But you need to remember that this analysis of other equity is required only in the third and the fourth case, which I covered with you yesterday. That means if you're making a consolidated balance sheet, not on the date of acquisition, but at a later date. So in case you're required to make a consolidated balance sheet on the acquisition date, then the step number 2A is not required. Then the second step in terms of the step number 2A, 2B, is getting the list of the net assets, or we can say equity on date of acquisition, which you can consider as a sum total of the share capital plus the pre-acquisition profits which you would get from the analysis of other equity. The step 3 is in terms of calculating the NCI. The step number 4 is calculating the goodwill. So NCI is not an issue. You got to calculate the NCI using Ind AS 103 on acquisition date. And just remember that you need to add a post-acquisition share. And then I give you the step number 4. Goodwill is absolutely similar what you have done in Ind AS 103, 100% same calculations. And of course, we'll have to take care of certain issues, which I will, tell you later. Then step number 5 is a crucial step, getting the other equity to be presented in the consolidated balance sheet, which is the holding company's own equity and the share of holding in subsidiary post-acquisition profits, which you will get in step number 2A. And then finally, in step number 6, you got to make a consolidated balance sheet, where I give you a total of 5 rules along with a note. And that note is yet to be elaborated. I need to first explain you that note before we go on to the practical illustrations. But I guess you remember the rules: that investment not to appear in the console, equity share capital only of the parent, not the subsidiary, other equity only of the parent and share in post-acquisition earnings. The pre-acquisition equity of subsidiary doesn't appear in the console. Goodwill NCI is represented as a separate line item in the balance sheet, and you got to aggregate all the assets and liability irrespective of the percentage, because the technique which we follow in Ind AS 110 is supposed to be called a full consolidation method. So whether there is an NCI or not, the aggregation of all the assets and liabilities would take place. And then I also made a mention that when you're going to do a consolidated balance sheet, you need to take care of any intercompany owings or any unrealized profits as well. So let's do one thing. Let's first of all talk about this unrealized profits and the intercompany owings before we do some full-fledged questions with you. So let's, I think, first do a basic discussion on the concept of, first of all, intercompany owings. Well, I guess this is pretty simple, but I think the main focus, what we need to keep in mind is that if there is any intercompany owings between the parent subsidiary, which step is it going to hit? That is important. So I think, let me tell you outrightly that if you look at the presence of a common debtor-creditor relationship between the parent and the subsidiary, I think as far as the 5 steps are concerned, no impact. If you're looking at the step number 1 or the analysis of equity or NCI, goodwill, or the balance sheet other equity, no impacts. So you need to remember that intercompany owings is only going to impact the step number 6, that is in the balance sheet. So let's take a very basic example to understand how the elimination will be done. So let's imagine that there is a balance sheet of the parent company. I'm making a T-shaped balance sheet just for understanding perspective. So there is a holding, there is a subsidiary, and there is a consolidated balance sheet. So this is the balance sheet of the holding company. This is the balance sheet of the subsidiary, and this is the balance sheet of the consolidated balance sheet of the group. Now let's imagine that either before or after the acquisition date, they entered into a transaction with each other, resulting in that, let's say, the parent company is reflecting the subsidiary as a debtor, and the subsidiary is reflecting the parent company as a creditor. So there was a credit sale between the two, and that led to a debtor-creditor relationship between the two companies, either before or after the date of acquisition. Now, what do we do? When you aggregate the debtors in the balance sheet, you would have added up holding plus subsidiary. And similarly, when you aggregate the creditors, you would have added up holding and subsidiary put together. Now, what am I supposed to do? So any amount which they owe to each other cannot be represented as a debtor and creditor in the same balance sheet. So what are you going to do? From the sum total of these debtors, we'll reduce the intercompany owings. Even from the creditors, we're going to reduce the intercompany owings. It's as simple as that. So elimination of intercompany owings would not pose any kind of challenge. And let me also caution you, it doesn't make a difference whether the creditor is in the parent's or the subsidiary's balance sheet. It could be either way, the treatment remains the same. So whether he reflects a debtors in the balance sheet and he reflects a creditors in the balance sheet, or it is the given situation, the elimination process is very simple and it's pretty logical as well. You cannot reflect in your own balance sheet that I have to recover something from my group and I need to pay something to the group. It would unnecessarily inflate the debtors and the creditor. So the treatment is pretty simple. Eliminate from the debtors and the creditors the common intercompany owings. Simple and straight. That means it doesn't make a difference to me the sale took place in a pre or post acquisition period. It doesn't make a difference to me whether it's a sale by holding to subsidiary or subsidiary to holding. I've got no concerns. Just in the step number 6, just eliminate the intercompany eliminations. Simple. Okay. Now let's go on to the next area of discussion, and that is what we call unrealized profits. If there has been some sale transactions between the parent and the subsidiary company, and they made a stock sale to each other, then it is quite possible that the goods are still unsold at the other party's end. Let's say the parent company made a sale to the subsidiary, and the subsidiary is yet to sell it to the outsiders. So a sale within the group is something which is unrealized in nature. Now, you need to be careful when it is unrealized profit, because we need to now consider, is the transaction supposed to be, a parent to subsidiary, or is it supposed to be subsidiary to parent? What we technically say, if there is a transaction by parent to subsidiary, it is called downstream. And if it is a transaction which is subsidiary to the parent, it is called upstream. Now, be careful. If there is a stock sale between the two companies, you need to identify that is it supposed to be a downstream transaction? Is it supposed to be a downstream transaction? Or you need to identify that it is supposed to be an upstream transaction. So when I say that it is a downstream transaction, as the word is indicated, that there is a sale by holding to subsidiary. So it's down. And when you say it is upstream in nature, the arrow direction would change. The sale is by subsidiary to holding. So be very careful when you look at the downstream upstream transaction, because if you've got unrealized profits, which is also called a stock reserve. So if you're given any, sale between the parent and the subsidiary, watch out who made a sale. So is it a sale by the holding to subsidiary, that's downstream, the accounting is going to be different. And if it is a sale by the subsidiary to holding, then it is upstream, the accounting is going to be different. So let's now consider a separate transaction with reference to down and upstream and see what is the impact on our 6-step model. I think let's do one thing. Let us consider a transaction. So on one hand, let's consider that there is a downstream transaction, and then we go to consider an upstream transaction as well. Okay. So let's consider that the holding company is got, let us say, 80% stake in the subsidiary. And he made a credit sale, and I'm not looking at the debtors creditors, for goods which are costing, let's say, 10 lakh rupees, and it was sold, the sale was made, let's say, at 12 lakh rupees. So let's say the parent company made a credit sale to the subsidiary for goods which are costing 10 lakhs at a sale price which is 12 lakh. Now imagine what happened in the balance sheet of the parent company. So this is the balance sheet of the parent, and this is the balance sheet of the subsidiary, and also have a look at the consolidated balance sheet. So this is holding companies, and this is subsidiary companies balance sheet, and this is the consolidated balance sheet. Now, we need to visualize that what is the impact of this transaction in the books of the parent and in the books of the subsidiary. Remember, we're focusing on downstream. So when the parent company made a sale to the subsidiary, he made a profit of 2 lakhs on the deal, so which would be a part of the other equity in the balance sheet of the holding company. And the subsidiary company purchased this stock, so he would reflect this stock in the balance sheet at 12 lakh, which is a cost to him, because he bought the goods from the parent company at 12 lakh rupees. So the cost to the subsidiary company is 12 lakh. So he would represent the stock at 12 lakh. So this is what would stand in their individual financial statements. Now let's see what do we need to do in terms of the consolidated balance sheet. I think it is pretty logical that the stock should not appear at 12 lakhs, but this 2 lakh rupees, which is a profit on sale, is unrealized from the group point of view. Because when the parent company made a sale to the subsidiary and the subsidiary could not sell it to the outsiders, the profit is not realized. You cannot make a profit out of your own group company. So from the consolidated point of view, the profit of 2 lakh rupees is unrealized in nature, called a stock reserve. So you eliminate that 2 lakh from the stock, and correspondingly the other equity, which includes 2 lakh, should also be eliminated. So it is as simple as that. That means you need to eliminate the profit element both from the stock as well as the other equity in the consolidated balance sheet, which means nothing is to be done in terms of the first 5 steps. If it is a downstream transaction, you can take care of this in the 6th step. But I would say that technically what you need to do when you go to the step number 5, and you calculate the other equity for the consolidated balance sheet point of view, remember, I gave you that step number 5 is calculating the other equity in the consolidated balance sheet. So my advice is that what you should do in step number 5, when you take holding company's own other equity, and to this you add the holding share in subsidiary post-acquisition profits, remember to reduce the stock reserve, that is unrealized profits, which relates to the downstream transaction. So I would say the net treatment goes like this, that you need to consider the step number 5. So when you consider the profits of the parent and the share in the post-acquisition profit stock, so you can do the inputs in terms of step 5, eliminating the unrealized profits, and you could eliminate in step number 6 the profit from the stock figure. So this is what you need to remember, that you need to do the treatment in terms of step 5 and in terms of step 6. And a little caution. Now, let's say, for example, the parent company made a sale to the subsidiary company and he has sold everything to the outsiders. Well, in that particular case, there is no unrealized profits. No accounting is to be done in the consolidated financials. Or let's say, for example, the parent made a sale to the subsidiary, and let's say 60% of the goods have been unsold. Then that means only 40% was sold to the outsiders, but 60% is unsold. So you're going to eliminate the profits to the extent of unsold goods only. So the caution which you need to remember, that this unrealized profit is eliminated to the extent of the unsold goods only. We don't need to eliminate the entire profit on sale, but proportionately, depending upon how many goods are still unsold on the balance sheet date. Simple and straight. Now let's have a look at, if it was an upstream transaction, then what is going to be the accounting treatment. So let's have a look in terms of upstream transaction. So if it is an upstream transaction, then in this particular case, we know that it is a sale by the subsidiary to the parent company. So let's consider the same transaction. Let's consider the same transaction in this case, and let's consider the balance sheet of the parent and the subsidiary. So this is the balance sheet of the parent. This is the balance sheet of the subsidiary. And this is, let's say, the consolidated balance sheet. So holding company's balance sheet, subsidiary company's balance sheet, and a consolidated balance sheet. Now let's consider a visualization. If the subsidiary company made a sale to the parent, then you can say his other equity would include the profit of 2 lakhs. And he would represent the stock purchased at 12 lakh rupees in his balance sheet. So he would be reflecting the purchase value of the stock, which is 12 lakh, and he would be representing the profit on sale to the extent of 2 lakhs. Now, what do you need to do in the consolidated balance sheet? I think one thing is pretty logical, that the stock cannot appear at 12 lakhs in the consolidated balance sheet. You need to definitely eliminate the unrealized profits because the goods are unsold. So you're going to eliminate that 2 lakhs from the figure of stock. But now remember one thing, that when you consider the other equity, this entire other equity doesn't appear in the consolidated balance sheet as a part of the other equity. This other equity, if you remember, is split between the parent and the NCI. Whatever is the profits earned by the subsidiary company, the parent and the NCI has got a share. So what do you need to do? Be careful. So what we're going to do in this particular case, we are going to consider that since 80% of this would have entered out here, you reduce 80% of 2 lakhs from the other equity. And the remaining 20% would have gone to the NCI. So you got to eliminate 20% from the NCI. So get this very logically clear. If the parent company made a sale, that is a downstream transaction, the profit is a part of the other equity of the parent, which is completely taken in the consolidated balance sheet. So the entire 2 lakhs gets eliminated from the other equity. But if the transaction is upstream in nature, where the subsidiary made a sale, you need to understand that this 2 lakh rupees doesn't entirely enter the other equity. Only the parent company shares enters the other equity, and the NCI share goes to the NCI. So we need to do a split in terms of the parent and NCI share. So in my example, considering 80% is the parent stake, so 80% gets eliminated from the other equity and 20% gets eliminated from NCI. Now, this can be at times, difficult to keep a track on. So alternatively, what you can do, this is one treatment that you do it in the consolidated balance sheet. But my, submission would be that what you can do in this particular case, that alternatively, when you go to the step number 2A, that means when you consider the analysis of the subsidiary company's other equity, which I'm yet to show you. But you know that you're going to do the analysis of this other equity in step number 2A. So I would say that why don't we eliminate this stock reserve relating to the upstream transaction, in the analysis of other equity itself. So when you do the analysis of the subsidiaries other equity in step number 2A, the better procedure is here because you've eliminated the unrealized profits, the other equity automatically gets rectified. The NCI automatically, gets a rectification. And then what you can do when you come to the step number 6, that is in the consolidated balance sheet, you can just take care of the elimination from the stock. Sir, can you just quickly consolidate the learnings on the unrealized profits? Intercompany owings is pretty clear, but just on the unrealized profits, a quick recap on things would be good. Okay, let's do that. So let me just give you a quick recap on the adjustments which I've given you, and let's consider that. And yes, okay, good morning all of you once again. Let's, I think, now begin the journey once again with you. So I'm looking at the concept of elimination of unrealized profits, where you need to distinguish downstream and upstream. Now get the focus clear that if it is a downstream or it is an upstream transaction, the stock is definitely inflated. Whether it is appearing in the balance sheet of the parent or it is appearing in the balance sheet of the subsidiary, the figure of unrealized profit has to be eliminated. So one common treatment is that when you go to the consolidated balance sheet in step number 6, you need to eliminate the unrealized profit of 2 lakhs from the figure of stock. So that's a common treatment. So the elimination of unrealized profits from the figure of stock is common, whether it is downstream or upstream in nature. Now, the caution. If you see that it is a downstream transaction, that means the profit is a part of parent's other equity. Now, if it is a part of the parent's other equity, you can take care of this in step number 5, that you need to eliminate that stock reserve relating to downstream transaction when you make a note on the other equity to be shown in the consolidated balance sheet. So that unrealized profits on a downstream transaction can be eliminated in step number 5 easily. So focus is step number 5, eliminate the stock reserve downstream. The focus is step number 6, eliminate the unrealized profit from the stock. But now, if it is upstream in nature, one way is that you eliminate the unrealized profits in the balance sheet by making a split in terms of parent and in terms of NCI. But I would say instead of this, the preferable treatment is that when you're going to do the analysis of this equity that is in step number 2A, you eliminate this unrealized profits at that stage. The subsidiary company's profit is including the 2 lakh rupees, eliminate that in step number 2A. So when you go to eliminate that profit, automatically when you go to divide that share between the parent and the NCI, automatically things will be taken care of. So you don't have to keep a track. So in this particular case, you do the treatment in step number 2A, and then finally in the balance sheet, the elimination of profit is done. So when you reach a question, you should be logically clear that if it is downstream, the impact is on step 5 and 6. But if it is upstream, the impact is on step number 2A and step 6. Get this clear. If it is downstream in nature, the impact is step 5 and step 6. If it is upstream in nature, the impact is step 2A and step number 6. So the moment you look at the transaction, your mind should be very clear, because many people get confused and they eliminate that unrealized profits on other equity, irrespective it's down or up. So remember, step 5 gets triggered in terms of downstream, and the step number 5 doesn't get triggered in terms of upstream. Then step number 2A is going to trigger. Right? I hope I am pretty clear on the permutation combinations. So unrealized profits eliminations done. Intercompany owings is pretty simple. You just need to take care in step number 6. That's it. I think now we are in a position to do some questions with you. So let's do one thing. We're going to start with some basic questions, and we're going to take you to some more advanced level of questions. If you remember, I had given you a total of 4 cases. So what I'm going to do, I'm going to do questions on all the 4 cases with you. Let's do a question where there is consolidation on acquisition date without NCI, and then consolidation on acquisition date with NCI. Then we can do consolidation later with no NCI. and a consolidation later with an NCI, and then a question on a chain holding. So let's do 5 questions with you, and you become expert on the area on consolidation. Let's begin the journey. Okay, so let's now take you to a question, and let's go to the comprehensive questions with you. So these are the questions with me. Let me in the meantime see if any questions coming at your end so far. No, I think everything is going good. Okay, so I think let's begin. We are starting with the very simple questions, and please follow the 6-step religiously. You're not going to go wrong. There might be few adjustments which we're yet to discuss, which we'll discuss in the question. So let me come to the question number 13. It's in the study material as well. Now we're looking at comprehensive practical questions with you. So let's have a look at the question number 13 on the screen. I guess it's visibly quite clear. I think so. So let me just read the question out to you. It says on 31st March X2, Blue Heavens acquired 100% ordinary shares carrying voting rights of Orange County for 6,000 lakhs in cash, and it controlled Orange County from that date. So we can very clearly see that 100% ordinary share means that there is no NCI. Then he says the acquisition date statement of financial positions. So you are given the individual balance sheets of both the companies on the acquisition date, and we're also given the fair values of the assets and liabilities of Orange County. So along with the balance sheet of Blue Heavens and Orange County, you're also given the presence of a fair value. Now you would remember in terms of Ind AS 103 that when you consider the acquisition accounting, the assets and liabilities are incorporated at a fair value. So during the consolidation process, you need to aggregate the assets and liability, and the liabilities of the subsidiary are going to be taken at a fair value. So this is going to impact some calculations. We'll see. Okay, then further, we are given some inputs. And we are given further information after the balance sheet. Only one simple little inputs is given. After the balance sheet, it says you need to prepare the consolidated balance sheet on 31st March X2, which is the date of acquisition itself. So it's very clear that this is the case number 1, which I gave you. It is the case number 1 where the balance sheet is on the acquisition date and there is no NCI. That's why I called it as a case number 1, the simplest case. Let's, I think, begin the journey. You can open up this question in the study material as well. This question is given in the study material also. So let me now start the journey. And we are going to first of all go on a step-by-step basis solving this question. So as I gave you a 6-step model, I'm going to go exactly on my 6-step model. So let's begin the answer. And I think the question number was 14th, I guess. Let me still verify this once again. So this was the question number 30. So let's go to the answer. That is answer number 30. So just to pinpoint, it is case number 1 for convenience of your revision. We can say this is a case where the consolidated balance sheet is made on the date of acquisition and there is no NCI. So this is the main focus of this question. Consolidation has been done on acquisition date and there is no NCI. Okay, let's begin with the step number 1. So at the first stage, we just need to identify what is the date of acquisition and what is the percentage, and it's very clearly given the date of acquisition is 31st March X2. And the percentage is very clearly given in the question, it's 100%. So pretty simple and pretty straight indeed. Step 1 is done. Then we go on to the step number 2. And in terms of step number 2, I gave you the focus that there are going to be 2 sub-steps. Do we need the step number 2A? Do we need an analysis of the other equity in this particular case? Because the balance sheet on the date of acquisition is already given. So I don't need any analysis of equity in this particular case. I can directly go in for the list number B itself. So analysis is not required. I will directly prepare the net assets list. But when you take the net assets list, it is to be taken, of course, at a fair value. So now let's do one thing. We're going to pick up the figures in this case, starting with the asset side. You are given building and other PPE. So we're given the building and other PPE. The fair value of this is 3,300. The next item in the balance sheet is inventory, and that's appearing at 600. So we are picking up all the net assets at a fair value, and the fair value column is given in the question. The trade receivables is 250. And the next item in the balance sheet on the asset side is cash, and that is 700. So since the balance sheet on acquisition date is given, you can directly get the net assets list. That's it on the asset side. And on the liability side, the only liability given is a trades payable, that is 150. So this is going to give us the net assets of the subsidiary at a fair value. So let's see what is the value. It's 3,300 plus 600 plus 250 plus 700 minus 150. This is coming to a net figure 4,700. Okay, so the step number 2, A and B is done. A was not required because we are already given the balance sheet of the subsidiary on acquisition date, except that when you organize the list, you need to take things at a fair value. Okay, then we go on to the step number 3. And in terms of step number 3, there is no NCI, so nothing is to be computed in terms of step 3. Then you go to the step number 4, and here we need to calculate the goodwill or the bargain purchase gain, as the case might be, which is purely an exercise based on Ind AS 103. You need to take the purchase consideration, add the NCI, which is 0 in this case, and compare it with the net assets, what you've already computed in step number 2B, and just get the data and get the answer. Isn't that so easy? You know, when you go on a chronological order of steps, life is simple because you know you're focused on each and every step, what is to be done. Now, when you're looking at the purchase consideration, the purchase consideration is appearing in the balance sheet as an investment in the parent's balance sheet. The investment which the parent made in the balance sheet is appearing investment in Orange County, that is 6,000. So that is the purchase consideration, and the net assets is 4,700. So we get the difference 1,300 as the amount of goodwill. Wow. Step number 4 is done. And then we go to the step number 5, where I need to organize the equity, the other equity. And I just need to be careful. Is there any stock reserves given? No. So we go to the step number 5. And in terms of the step number 5, we go to organize the other equity, which would appear in the consolidated balance sheet. You got to consider holding company's own other equity. And to this, we need to add the share of holding in subsidiary post-acquisition earnings. In this case, there are no post-acquisition earnings because there is no post-acquisition period. We're doing the consolidation on acquisition date itself. So if you look at the other equity, that is retained earnings, the other equity is the retained earnings of the parent. The retained earnings of the parent company is appearing at 10,200, and there is no post-acquisition share, no elimination of unrealized profits. So this is the other equity in the console. And I think now we are done. We just need to make a consolidated balance sheet in step number 6. So let's go to the step number 6. And in terms of the step number 6, we need to make the consolidated balance sheet, keeping the rules which I give you for consolidation. That you need to consider investments will not appear, share capital of the parent, other equity, what you've taken in step number 5, aggregation of all the assets and liabilities in full, goodwill NCI represented as a separate line item, and elimination of intercompany owings and the stock reserves which are not there. So let's begin with the asset side of the balance sheet. So we focus on the asset side, the non-current assets. So in the non-current assets, we've got building. And now what do you need to do? Aggregate the things, building and other items. So you need to be careful that when you aggregate them, you need to aggregate the book value of the holding and the fair value of the subsidiary. So we're going to consider the building at 7,000. For the parent company and for the subsidiary, we got to consider the fair value. So this works out at 10,300. That is the building. And I guess least we forget, let's also consider the goodwill as well. So the goodwill is already computed at 1,300, which we've already done in the earlier step. That is step number 4. So for your reference, I'm just giving the reference. Step number 4, you got the goodwill. Next item in the balance sheet is investments. Investments would not appear in the console. My rule tells me. And then we go to the current assets. We've got inventory. Same concept applied, book value for the parent and the fair value for the subsidiary. So inventory is 700 plus another 600. So that works out at 1,300. And the next item we given the trade receivable, same application. So the trade receivable is supposed to be 300 plus another 250. And that makes it a total of 550 in the console. And then we given the figure of cash, and the cash is supposed to be 1,500 plus 700. That makes it 2,200. So my asset side of the balance sheet is done. Oh, wow, this is too simple to come in the exam. So then why are we doing this question? Warm-up exercise in terms of things. So let's get the total of the consolidated balance sheet. So this is going to be 10,300 plus 1,300 plus another 1,300, 550 and 2,200. That works out at 15,650 is the total of the consolidated balance sheet. Now let's also go to the liability side of the balance sheet as well. And on the liability side, we've got equity and liabilities. So let's first consider the equity, in which we've got number 1, the share capital. Now, when you consider the share capital, you know it that we need to consider only the parent company's share capital. So just take the parent company share capital, which is appearing at 5,000. And then you consider the other equity, and this you can pick up from step number 5 for your reference. And we've already computed that's 10,200. That's the other equity to be shown. And I guess in this question, we don't have an NCI, but be a little careful, because when you reflect the NCI, it should appear under the head equity. So right now we don't have any NCI. But if there is an NCI, it is going to be presented as a last item under the equity section. And then we are given the current liabilities. So let me take it out here. So we've got the current liabilities, trade payable. So this is again going to be the sum total of the parent and the fair value of the subsidiary. So that works out at 450. And I think that's it. We should get the total of the consolidated balance sheet. So this is 15,200 plus 450. This is 15,650 is the total. Wow. So let me, I think, ask you, I guess you should be pretty comfortable in terms of the 6 steps I've done. A very basic question, just to give you a flavor of how we have to do a DTA, DTL calculations on the fair value as well. 100% yes. Now, there is a lot of safety in terms of the consolidation questions. You know, I don't know whether I should recommend that kind of question to you or not. But if you look at the paper on the elective paper on GFRS, there is a beautiful question which is given on, a combination of a consolidated balance sheet and a business combination. But trust me, that's a very good question, but it cannot come in the exam, because that kind of question in FR can't be expected, because that would take you easily around 1.5 to 2 hours to solve. But trust me, if you do that particular kind of questions, you're going to see everything in that kind of question. Deferred tax, of course. And when it is deferred tax with all these kind of inputs, fair value adjustments and stock reserve, oh my God, you need to love that kind of question. So I'm not going to do that question, but if you want to get the flavor in terms of deferred taxations along with the consolidation standard, the GFRS elective paper has got those kind of case studies as well. There is, a three kind of companies in that. A consolidated P&L is there, a consolidated balance sheet is there. I would have loved to do that question, but I think from FR point of view, it becomes too technical indeed. But you can maybe try this out. Okay, so this one is done. Pretty simple. So I think your comfort zones on this kind of a question should be undoubtedly a 10 by 10. If it is below that level so far, I think you are in a dangerous zone. I don't think so this kind of a question would pose any challenge. Simple application. Okay. Let's take it further. This was the case one. Now I'm going to go to the next question with you, which is on the case number two. So let's have a look at the case number two now. So in terms of the case number two, it's an extended question. It's not 92. It should be question 30. So let me just read the question to you. Question number 14. It says the facts are the same in the above question. However, Blue Heavens acquires only 75% of the ordinary shares, and the consideration which he pays is supposed to be 4,500 lakhs, and you are required to make a consolidated balance sheet on March X2. The only difference in this case is that there is a 25% NCI, and he has changed the investment figure. Now, one thing very careful. If you're going to change the investment figure, like for example, I make this 6,000 as 4,500 for the question, I think I need to correspondingly change the figure of cash as well, right? Because if you were to say that, you paid only 4,500 lakhs of consideration and I now need to, consolidate things, then you're going to change the investment and reduce it by 1,500. So correspondingly, the cash has to be increased. Otherwise, the balance sheet is not tallied. Now, with this new balance sheet, that is the new investment figure and the new cash figure, you got a 25% NCI. Let's see how the impact will be done. I don't think so. I'm interested in doing this question all over again. Let me make the changes to the existing solution with a 25% NCI. That's better. So let's do one thing. Let's pick up the solution. And we are going to make some changes in the solution with a 25%. So let me change the color. And I guess I can show you the changes. So we're looking at the answer number 14 with the changes in the solution. So let's watch it carefully. Step number 1, instead of 100%, you get 75%. That's 1. Let's have a look in terms of the step number 2B. Do you think there are any changes in step number 2B? I don't think so. There are any changes in step number 2B. And as it is, if you're wondering on a cash, we made a changes in the cash of the parent, not the subsidiary. So I think the step number 2B remains as it is. Let's go to the step number 3. NCI is to be taken at what value? Is it to be taken at fair value? Or is it to be taken at PASNA? I am nowhere given in the question what is the fair value of the NCI. So I think we comfortably go with NCI at PASNA. So for this purpose, 4,700 is the net assets computed and 25% belongs to the NCI. So you can take the NCI at PASNA. So we consider 4,700 into 25%. That's 1,175. Goodwill, of course, we'll have to make the changes because the purchase consideration has undergone a change. So let's do the calculations all over again in terms of goodwill. So the purchase consideration is 4,500. The NCI is 1,175 as we've computed at step 3. So 4,500 plus 1,175, that's 5,675. The net assets remains at 4,700. So we get the goodwill, that's 975. I'm just making the changes in the solution because the figures are almost the same. So with the presence of the NCI, the only thing which has undergone a change so far is that you made the calculations of NCI at Pasna, and accordingly, the goodwill calculations have undergone a change. Okay, let's see further. I guess in terms of the step number 5, I guess the status again remains the same. No changes at all because there are no post-acquisition earnings. Now let's have a look at the changes in the balance sheet. In terms of building, everything remains the same. Goodwill is going to change to 975 as we have computed. And cash, we need to change the figure to 3,000. Because the cash position undergoes a change. So this cash is going to become 3,700. And I guess that's it on the asset side. So that's 10,300 plus 975 plus 1,300 plus 550 plus 3,700. I think the total of the balance sheet changes to 21,775. Okay, and then we go further. Okay, I think let me just check the total. 10,300, 10,300, 975, 1,300. This is, sorry, 16,825. This is incorrect total. My mistake. So this comes to, I think, 16,825 is the total on the balance sheet now. Okay, share capital continues to be the same, other equity is same, but NCI is now entered. And the NCI, what we computed was 1,175. And I guess that's it. Let's see if the total of the balance sheet is also matching. So 5,000 plus 10,200 plus 450 plus 1,175. Yes, it's a perfect match. 16,825 is the total of the balance sheet. I think I can almost give you a 99% guarantee that you cannot get these kind of questions in the exam. Too simple to come. Where you're not required to do any analysis of other equities. So whether it is a case of consolidated balance sheet on the acquisition date with without NCI, I see very less chances coming in. That was purely a warm-up exercise in terms of things. Wow. So this is done. The case 1 is done and the case number 2 is done. Now let's go on to the case number 3 with you. And then we're going to do the case number 4. And now a little technicalities will get involved. So we're going to push a little technical things at this stage. Let's take it further. So let me just go back now and go to the next question with you. So we are looking now at case number 3. So let me go to the case number 3 question now. Question number 15. Let's zoom it a bit and let's have a look at the question number 15. Let me just clear this out. Okay, so now we can have a look at the question number 15. This is a decent question, though there is no NCI, but you're going to see some adjustments out here. So now be a little careful, friends. The level is going to suddenly increase in this case. So we're going to see a slight increase in the level in this case. So I'm now going to tone down a speed a bit. Because earlier 2 questions, I did it a little faster. I know that intentionally, but now I'm just going to tone down a speed a bit because some technicalities you're going to see. Let's have a read on the question number 15 with you. Now be careful as we read the question. This is also given in the study material as well. It says DEF acquired 100% ordinary shares. So we're given that you've acquired 100% ordinary share, which means there is no NCI. And it says these shares are acquired on 1st October X1 and on 31st March X2. So you are given the balance sheet 6 months later. The acquisition is on 1st March and the balance sheet of the 2 companies is given on 31st March X2. So one thing is very clear, it is a consolidation at a later stage and there is no NCI. Okay, let's see further. Now we're given some more information in the question. And let's have a look further on the information. So let's see. So after the balance sheet is been given, we are given more inputs. The retained earnings of XYZ shows a credit balance of 3 lakh on 1st April X1. So this is given so that we can do the analysis of other equity. It says out of which a dividend of 10% is paid on 1st November. So the balance at the beginning of the year was 3 lakhs in the RE, retained earnings, out of which a 10% dividend is paid by the subsidiary. The parent company credited the dividend received to the retained earnings account, so that is a correct treatment. And the fair value of the machinery on 1st October is given, and the depreciation rate is 10%. So we're given the book value of the machinery in the balance sheet, and here we're given the fair value with a depreciation rate. The following are the increases of the fair value as per the respective Ind AS with a book values on 1st October, which are to be considered while consolidating the balance sheet. So you're given the fair value of the assets and liability, and we need to incorporate them as a part of the console. Then he gives you a note that it may be assumed that inventory is still unsold on the balance sheet date. So whatever is the fair value change, that inventory is still unsold on the balance sheet date, and the trade payables also not yet settled. Because once I'm going to make the balance sheet, the trades payable, since it is still unsettled, will be updated at a fair value. The inventory is unsold, so it will be updated at a fair value in the consolidated balance sheet. Also assume that other reserves on March X2 is same on the 1st April X1. We require to make a consolidated balance sheet on 31st March X2. So a couple of adjustments are given, and typically those adjustments are with reference to the fair value adjustments of assets and liability. Now, how would they impact my question? We'll see that in the solution. So let's begin. So I'm looking at question number 15. So let's go step by step. So let's have a look at the answer to the question number 15, which is case number 3. So let me put it as a focus that this is case number 3. And the focus in case number 3 is consolidated balance sheet later, not on the date of acquisition. And the focus is that there is no NCI. So we've got to focus that there is a consolidation which is done at a later date, but there is no NCI. The only case left over is with NCI. That's not a big deal. Okay. So let's begin with, first of all, the step number 1. And in terms of step number 1, you need to just organize two things. What is the date of acquisition and what is the percentage? That's it. So very clearly, I am given in the question that as far as the date of acquisition is concerned, 1st October X1. And as far as the percentage is concerned, it is 100% because there is no NCI. So I think step number 1 is never ever going to pose any challenge. Then we go to the step number 2. And in terms of step number 2, you got to do 2 steps. One is the analysis of other equity. Now, careful. Let's first of all now give you a bit logic. Now watch this carefully. Just understand the logic first of all before I do the analysis. This is the balance sheet of the subsidiary company. This is the assets and this is the liability. This is the share capital and this is the other equity. Now, one way to calculate the net assets is that you take the assets minus liability. You're going to get the net assets at book value. So one way to calculate the net assets is that you take the assets minus liability and you get the net assets at book value. And I told you we're not going to use this technique. I said that yesterday itself. The other way to calculate the net assets is that you take the sum total of these two and you again get the net assets at book value. The stress is on the word that you're going to get the net assets at a book value. But since we need for the goodwill calculations and even for the NCI calculations, net assets at a fair value. So what you need to do in this particular case, you need to add or reduce, whatever the case might be, whatever is the difference between the fair value versus the book value. I think makes logical sense. You get the net assets at a book value, and you need to take care of the increase or decrease in the book value versus fair value so that you are able to convert this in terms of net assets at a fair value. Which means as a part of the analysis of other equity, you'll have to incorporate the changes in the book value versus fair value. I put it again. Since you are picking up the other equity, which is given in the balance sheet of the company, which is based on book value of the net assets, the analysis of this other equity is going to give you the net assets at a book value. Because in the individual balance sheet of the subsidiary, all the assets and liabilities are appearing at a book value. So when you consider the sum total of the share capital other equity, it is nothing but net assets at a book value. So what you need to do, you need to incorporate the fair value book value difference and then get the net assets at a fair value. So every time you do the analysis of other equity, you will also incorporate the changes in the fair value versus book value as a part of the analysis. I hope I made myself clear. So we're going to incorporate this because we need to get the information that is net assets at a fair value. So let's begin with the step number 2A. So I'm now going to the step number 2A, and that is analysis of other equity. Now watch this carefully, how the analysis of the other equity is going to take place. We are going to go very, very systematic. I'm now going to give you certain phases in which you need to move. There are certain phases in which you need to move. So watch this now carefully. So what I'm going to do, I am going to first of all create some columns for convenience. One is a particulars column, and one is a pre-acquisition column, and one is a post-acquisition column. So we're going to create some columns. One is a column for particulars, and one is a column because we want to do the analysis. We need pre-acquisition and we need post-acquisition. Now see the focus very clear. The next 5 minutes is going to be very crucial, 5-10 minutes, because I'm going to give you how you need to go systematically in the analysis of other equity. Now, in this particular case, first of all, define the pre and the post acquisition period. Your acquisition date is 1st October X1. So you can say anything which is before 1st October X1 is pre-acquisition in nature. And you can say anything from 1st October X1 till the balance sheet date, that is 31st March X2, is post-acquisition. So when you do the analysis of other equity, divide the columns in pre and post and define it in terms of dates, so that you very clearly can see the position that anything before acquisition date is pre, and from the acquisition date till the balance sheet date is post. Now, when you're doing this analysis of other equity, you've got a total of 3 focus points. You got a three focus point. Now, what is the first focus point? You are going to look at the balance sheet of the subsidiary company. That is one focus point. So what are we going to do? At the first instance, your focus is just concentrate on the balance sheet of the subsidiary. See what is the other equity in the balance sheet of the subsidiary. The other equity in the balance sheet of the subsidiary is comprising of other reserves and is comprising of retained earnings. So you need to focus on the subsidiaries company's balance sheet, other equity, and do the analysis. So there are 2 elements of that other equity. One is the retained earnings and one is the figure of other reserves. So take care of that analysis. So let's begin. Let's begin with that analysis. So we are given, first of all, the figure of other reserves. Now, when you do the analysis of other reserves, don't be in a hurry. Hurry will make a curry. So don't be in a hurry. My advice is make a time scale and then proceed. I'm going very systematic to you. So when you're looking at the analysis of the other equity, go with the elements within other equity. You given other reserves. Now let's make a time scale starting at the beginning of the year, that is 1st April X1 and ending on March X2. Make a time scale represent the financial year in the question. And also pinpoint that what is the date of acquisition, that is 1st October. So make a time scale carefully and see this is the balance at the beginning, the balance at the end, and there is an acquisition date somewhere in between. Now, if you look at the balance sheet of the subsidiary, the other reserves is appearing to the extent of 10 lakh. That is on 31st March. And if you go to the additional information in the note number 2, it says that the other reserves on 1st April X1 is same as March X2, which means it was 10 lakhs even on this date. So there has been no change. There has been no change in terms of reserve. It was 10 lakh on 1st April and it is still 10 lakhs at the end of the year. So we need to see that whatever is the position before 1st October is entirely pre. So we can say that this 10 lakh rupees entirely is pre-acquisition and there is no post-acquisition in terms of other reserve. So once you make a time scale, you'll be able to get the picture very clear that this is the balance which is there before the acquisition date. So it is earned in the pre-acquisition period and it is entirely pre. Done. Then let's go to the next component. And the next component of other equity in the balance sheet is the figure of retained earnings. So we are given the retained earnings. Make your time scale again. Make your time scale again and do the figures. Now, this is the position 1st April X1. This is end of the year March X2. And in between, we're given 1st October date of acquisition. Remember to make a time scale so that you don't go wrong and you go absolutely systematic, that you are able to make a time scale of the current year and represent the acquisition date. Now, in this particular case, you can see we are given the retained earnings in the balance sheet is appearing to the extent of 8.2 lakhs. So on the balance sheet date, 31st March, it is 8.2 lakhs. And then further, I am also given another information. It says in the additional information, retained earnings of XYZ on 1st April is supposed to be 3 lakh rupees. So this is the position at the beginning. Now, careful. So you can see 3 lakhs is the balance at the beginning, 8.2 lakhs is the balance at the end. Don't run to the conclusion that the earnings are 5.2 because we're also given some dividend payments. It very clearly says in the additional information that out of the 3 lakh rupees, the company paid a 10% dividend. Now, the dividend is paid at the rate of 10%. So let's see what is the amount of dividend. If you look at the subsidiaries balance sheet, the share capital is appearing at 20 lakhs. The subsidiary company paid a 10% dividend on 20 lakh rupees, which means they paid a dividend to the extent of 2 lakhs. So you can say that out of the balance at the beginning, only 1 lakh rupees is left on 31st March. So we are trying to calculate that 3 lakh was the balance at the beginning. But then the company paid a 10% dividend on 20 lakh rupees. So what is available out of the 3 lakh rupees at the end of the year is just 1 lakh. Now you can see that what is the increase in terms of the profits. So we can say that the profits earned during the year is supposed to be 7.2 lakh. So you need to be very careful when you do the analysis that we cannot compare 3 and 8.2. You need to compare that 3 lakh was the balance at the beginning, but on 1st November, you paid a dividend. So what is left over at the end of the year is just 1 lakh. So what is the increase in the profits during the current year is 7.2. Now, friends, watch this carefully because this can be disturbing. So watch this now very carefully. So what do we write in the outer columns now? The balance on 1st April was 3 lakh rupees, though what is available on 31st March is 1 lakh, but I am going to write 3 lakhs in the outer column. Sir, now you need to hear me very carefully. The company paid a dividend on 1st November. The company paid a dividend on 1st November. And this is the status on 1st October. I need to calculate the net assets on the acquisition date. And at that time, the dividends was not paid. Mind my words carefully. So I would say, as a convenience, what you need to do, since this is the position on 1st October, the dividends were not paid until 1st November. So as a part of my net assets, what is available is 3 lakh and not 1 lakh rupees. Did you get the point? So you need to be careful when you do the internal workings to calculate the increase in the profits. I made a reduction of dividend because this is the position on 31st March after dividend. And this is the position on 1st April before dividends. So 3 lakh and 8.2 lakh is not comparable because 3 lakh is without a dividend and 8.2 is after dividend. You need to get the base correct. So after reducing the dividend, this 1 lakh is after dividend, 8.2 lakh is after dividend. So we can compare the two and get the profits. But remember, when you go to take the figures in the outer column, the objective of this analysis is to get the net assets on acquisition date. So we know that on 1st October, 3 lakh was available. The dividends were paid on 1st November. So in the outer column, remember, you will take 3 lakhs and not 1 lakh in the outer column. Keep that in mind so that you don't go wrong. Then this 7.2 lakhs is a profit earned during the entire year. And we can say that out of this, 6 months is pre and 6 months is post. Because 7.2 lakhs is earning for the entire year until 1st October, 6 months is pre and 6 months is post. So 7.2 lakhs will be divided in the time ratio that is 6:6. I hope, friends, I am absolutely clear. You need to be very cautious if you are given some dividend information in the question. It can be disturbing to you. So what you need to go with a proper time scale as I gave you. Especially when it comes to the retained earnings and there has been some dividends paid, you need to reduce the dividends to get the same base. But when you take the figures in the outer column, be careful because you need the pre-acquisition position on 1st October. This is without making a payment of dividend. Dividends were not paid till 1st November. So we're going to take the figure 3 lakhs and of course the increase is divided in a time ratio. I hope I am absolutely clear with the agenda. Okay. So this is focus number 1, that you need to consider the analysis of the other equity by concentrating on the balance sheet of the subsidiary, phase 1. Now let's go to the phase 2. We're continuing this. So I'm just going to continue this back and let's make the format. So I'm continuing with the analysis of the other equities. So let me just continue with the columns, a particulars column, and there is a pre and a post acquisition column. So this is particulars, the analysis continues. There is pre-acquisition defined as pre-1st October and there is post-acquisition. So this is 1st October X1 till March X2. And this is supposed to be a pre-1st October X1. Okay. So let me now remind you back, friends, out here. When you are doing the analysis of other equity, there are 3 focus points, as I said. The first focus point is look at the subsidiary's balance sheet and do the analysis of other equity. Then the focus point number 2. In terms of the focus point number 2, you got to see the additional information. You got to see the additional information and concentrate on the fair value adjustments, so that you never ever go wrong. Because as I said, that the balance sheet is reflecting the assets and liabilities at a book value. So you need to consider the difference in the book value and fair value as a part of this analysis. So that once I get the pre-acquisition profits, it is including the fair value changes and I would get the net assets at a fair value. So once you're done with the balance sheet of the subsidiary, the second focus point is looking at the additional information for the fair value adjustments. Let's go to the additional information. Now, in terms of the additional information, I am given, it says that the fair value of the plant and machinery is given to me. It is 20 lakhs on 1st October. And the depreciation rate is supposed to be 10%. So don't be in a hurry. Again, make a time scale. Your financial year is April X1 and ending on March X2. And your date of acquisition is 1st October. Create a time scale in your analysis. Get the dates clear so we can see things clearly. Now look at the balance sheet of the subsidiary company. The plant and machinery is appearing at 13.5 lakhs at the end of the year. And we are given in the additional information that the plant and machinery fair value on 1st October is appearing to the extent of 20 lakhs. Now, the revaluations will be done on the date of acquisition. So we know that the fair value on the date of acquisition is 20 lakh. But if you want to get the increase or decrease, you need the book value on 1st October. 13.5 lakh is the value on 31st March, but you need the book value on the 1st October. So what we need to do, we need to do some calculations now at this stage. Now let's watch the calculations. I am given the depreciation is at the rate of 10%. If the depreciation is at the rate of 10%, this means that this represents 90%. So if this represents 90%, you can gross it up and calculate what is 100%. That is 15 lakhs. Because if your depreciation is 10%, this represents 90%. Gross it up and you are going to get 15 lakhs by grossing up. So you gross up the figures and you get the figure of 15 lakhs, which is supposed to be the book value at the beginning of the year. It is the book value at the beginning of the year, but I need the book value in the middle of the year. So if you need a book value in the middle of the year, just take care of a 6 months depreciation. So from 15 lakhs, you got to reduce 10% depreciation only for a period of 6 months. So when you consider a 6 months depreciation, that's coming to, I think, 0.75 is the depreciation. So you are going to get the book value 15 minus 0.75, that is 14.25 lakhs. So you can get the difference, that is 5.75 lakhs is the difference between the book value and the fair value in this case. So you get the difference between the fair value and the book value on the acquisition date, and this figure comes in the outer column, that is 5.75 lakhs. Let's get this again very straight. So what do you need to do when you are looking at the fair value adjustments? Organize a time scale and see that what is the position at the end of the year, and the revaluations will be as a part of the acquisition date. So you need to be careful on the dates, that this is at the year end, 10% depreciation rate, you gross it up to 15. But you need the status in the middle of the year, so you take care of a 6 months depreciation, and then you compare the fair value and the book value, and you get the fair value increase. Increase means, again, it's added in the pre-acquisition column. Had it been a loss, I would have put it in the brackets. This is one fair value. There are more fair value adjustments given. Let's continue. So we are also given some fair value adjustments for land, building, inventory, trade payable. Let me just continue the columns. So let me just continue this chart itself. Same columns to be continued. So we've got the inputs in terms of the pre-acquisition, the post-acquisition, and the particulars. I'll consolidate this picture as well. When we go to do the next question, things will become even more consolidated well. So we're looking at the other fair value adjustments now. Apart from the machinery, which was explicitly given in the question, there are some more fair value adjustments. So we are given the increases by comparing the fair value and the book value. The direct increase is given. Land and building is got an increase, and that's to the extent of 10 lakhs. And this is a part of the net assets at the acquisition date pre. We're also given the inventory increase by 1.5 lakhs. So there is an increase in the inventory. So that is also a gain. And there is an increase in the trades payable. By the way, you need to be careful. Increase in the trades payable is a loss to me. If there are increases in the value of the assets, it's a gain. And if there is an increase in the value of the liability, it's a loss. So you need to consider the liability change as a loss in the brackets. So fair value adjustments taken care. Now, another important thing. When you've taken care of the fair value adjustments, you need to take care of any additional depreciation as well. Though in the question, I am not given any depreciation information on buildings. So in the absence, I can't consider any depreciation prospectively. Because when you're going to do the fair value adjustments, another focus point is to get the impact of additional or excess depreciations, if any. Now, in case of land and building, I can't consider because the depreciation rate is not given in the question. Since it is not given in the question, I cannot take care of any additional depreciation on a prospective period. Inventory, trade payables as it is are not items which are depreciated, so no prospective accounting. But in terms of this plant and machinery, the depreciation rate is given. So you need to consider the additional depreciation as well. And this is going to be considered in the post-acquisition column because it is going to be a prospective accounting. So be careful with the fair value adjustments that you need to take care of the adjustments, get the gain or loss in pre, and then you need to consider the fair value. You can say the additional depreciation in a post-acquisition column. Now, let's get what is the gap in terms of depreciation. Now, you need to consider what depreciation would have been taken. The company would have taken a depreciation, you can say, on 20 lakh rupees. But we took a depreciation on 15 lakh rupees. So we should consider a 10% depreciation for the remaining 6 months. The company took a depreciation based on 15 lakhs book value for the entire year, but they should have taken a depreciation based on 20 lakhs. So we are comparing that the difference that is 5 lakhs at the rate of 10% for the remaining post-acquisition period. So we get an additional depreciation that is 0.25 lakhs. That is the additional depreciation taken. Compare what should have been taken versus what is taken only for the post-acquisition period, because it is going to be a prospective change. Okay. That is the second thing, focus point to be taken care. You go systematic, trust me, you'll never go wrong. So the first focus was that you're focusing on the subsidiaries, balance sheet, other equity. The second focus point is the fair value adjustments in the additional information and also looking at the additional depreciation. Now you get the third focus point. Go very systematic, that in the analysis of the other equity, there are certain focus points. The third focus point, if you remember, look for the question if there is any stock reserve relating to upstream transaction in nature. Because we decided that once there is any unrealized profits and it is upstream, you need to eliminate that unrealized profits in step number 2B. So am I given any information on any stock sale between the parent and subsidiary? No. Since I'm not given any information, nothing is to be done. So we can now conveniently get the sum total of the pre and the post acquisition. No worry, I am going to consolidate the picture, but you need to go systematic. Do this question by hand today itself. And if you're able to catch the steps, what is to be done at each stage, you can do comprehensive questions. Let's do one thing. Let's consolidate the picture. I think my focus now is purely in terms of the step number 2A, that is doing the analysis of other equity, because earlier questions we were focusing in terms of that the acquisition date and the balance sheet date was same. So we never did analysis of other equity. But in this case, we need to do analysis because the balance sheet is made at a later date. So what is the focus point in this particular case is You need to do the analysis of other equity. And when you do this analysis, organize the data first of all, define your pre and the post acquisition columns clearly with the help of the dates. Anything which is pre-acquisition date is pre-acquisition, and from the acquisition date to the balance sheet date is post-acquisition. When you look at the analysis of the equity, get 3 focus points very clear. You need to first of all pick up the other equity in the balance sheet of the subsidiary. So you got to focus on the balance sheet of the subsidiary, and in the other equity, you've got other reserves, you've got retained earnings, you do the analysis. When you do this analysis, you make your time scales and consider the position at the beginning and the end and see the acquisition date. And you can clearly see that there has been no movement in the current year, so the entire figure becomes pre. But in terms of the retained earnings, you need to be very careful because dividends can create a little problem. So what you need to do, you need to organize the position at the beginning and the end in the same manner, but be careful that the figure 8.2 and 3 is not comparable, because 8.2 is after dividend and 3 lakh is before dividend. So you need to first of all reduce the dividends so that they come on the same base after dividends, so that you can compare the two and get what is the increase during the year. But when you take the figures in the outer column, remember, the analysis is being done on 1st October. I want to know the net assets. The subsidiary company paid a dividend on 1st November, which was after the acquisition date. So at that time, they had a total of 3 lakhs in the retained earnings, not 1 lakh. So when you take the figure in the outer column, take the figure to be 3 lakhs and not 1 lakh. So careful that inner, we need 1 lakh, outer column, we need 3 lakh. And then you take the increase in a time ratio. First focus is done, then you go to the next focus point, and you need to now concentrate on the additional information for any fair value adjustments, if any. Because when you do the analysis of the other equity, you're doing the analysis of the net assets at a book value. But since there has been fair value adjustments, be careful. For that, again, go for a time scale. Very carefully see that revaluations is done in the middle of the year acquisition date. Organize the value at the beginning, get the values at the beginning, compare the fair value in the middle of the year versus the book value in the middle of the year, get your revaluations gain. Whatever is the revaluation gain or loss will always be pre-acquisition, because you're doing this exercise on the acquisition date. So this is all going to be pre, and then be careful that for those items where depreciation rates are given, you need to consider the additional or the excess depreciation. If there is a revaluation increase, you got to consider additional depreciation. If there is a revaluation decrease, you need to reverse the excess depreciation. Compare what was taken, what should have been taken, and get the differences. And then the third focus point is that if there is any stock sale between the parent subsidiary upstream in nature, you need to eliminate the stock reserve in the post-acquisition column, because we'll generally assume that the sale took place in the post-acquisition period. Wow. The 3 focus points done. Let's now consider the figure in the pre and post columns in total. So this is, I think, 10 plus another 3 plus 3.6. And this is another 5.75. And this is another 10 plus 1.5 minus 1. I think this is coming to 32.85 lakhs. This is the figure in the pre-acquisition, 32.85. Let's see the figures in the post column. And I think the post column, we've got 3.6 minus that 0.25, and that's it. So this is coming to 3.35 lakhs. That is the post-acquisition earnings. This is step number 2A. I'm now going to go to step number 2B. So let's go to the step number 2B. Let's go to the next one. So step number 2 is the most crucial step, because after that, it's not a challenge. So let's go to the step number 2B. Now we need to get the net assets at a fair value. So you got to consider the sum total of the share capital. And to the share capital, you need to add the pre-acquisition profits. So as you can already see that as a part of the pre-acquisition profits, you've already incorporated the fair value adjustments. So you can say that once you're going to consider the share capital and the pre-acquisition, including the fair value adjustments, the net assets automatically is at a fair value. So look at the balance sheet of the subsidiary. The share capital is supposed to be 20 lakhs. And the pre-acquisition profits we've just computed, that was 32.85 lakhs. So with this, we'll be able to get the net assets, that is 52.85 lakhs is the net assets on the date of acquisition. Okay, so far so good. I guess let me see if any questions coming in so far. No, okay, that's great. But I hope, friends, you got the picture, right? So when you do the analysis, I hope you got the 3 focus points very clear. You need to solve this question by your own hands today itself, because the validity in terms of, understanding of this expiry is very fast. So you need to do this with your own hands today, then things will be valid. Then we go to the step number 3. And in terms of step number 3, we are now going to consider the NCI. So NCI is not given in the question. So there is no NCI. 100% stake belongs to the parent. Then we go to the step number 4. And in terms of the step number 4, we need to calculate the goodwill or the bargain purchase gain. Similar calculations like Index 103, you got to consider the purchase consideration plus the NCI, and compare this with the net assets, and you go to get the amount of goodwill or the capital reserve. Now, as far as the purchase consideration is concerned, you are given the purchase consideration as investment. If you look at the investment in the balance sheet of the parent, it is appearing at 34 lakhs. There is no NCI. So we compare this with the net assets, that is 52.85 lakhs. So this time we are getting a capital reserve. So if I take the difference, this is 18.85 lakhs. This is the capital reserve. It's not a goodwill, but we're getting a bargain purchase gain, which is typically, you can say, is a capital reserve. Okay. Step number 4 is done. Now let's go to the step number 5 with you. And then we can make the consolidated balance sheet. So let's consider step 5, which is calculating the other equity in the consolidated balance sheet. Now, when you're considering the consolidated balance sheet other equity, you've got again, a simple focus point, stock reserve to be taken. So what we're going to do, we're going to consider holding company's own other equity, to which you're going to add the share of holding in subsidiary post-acquisition profits. And you need to reduce any stock reserve, which is downstream in nature. So these are the basic focus points. Another focus point which gets added now. We were given in the additional information that the parent company received a dividend from the subsidiary, and that was taken to the retained earnings of the parent. But can I say that money which they received is not an income from the group point of view? So the retained earnings of the parent company includes that amount, but can I say it is not an earning from the group perspective? So you need to eliminate that amount of earnings. So what are you going to do? You're also going to eliminate the dividend received from the subsidiary company, because the dividend which you received from the subsidiary company is included in the earnings of the parent, but from a group point of view, it's not an income. So we need to eliminate the same. So let's consider the holding company's other equity. You are given other reserves. Let's take it column wise. And you're also given the retained earnings. So we're given 2 components. So let's consider the 2 columns separately. So if you look at the balance sheet, the other reserves is appearing at 24 lakhs. And the retained earnings of the parent company is appearing at 5.72 lakhs. Now let's consider what is the share in the post-acquisition earnings. Now, in terms of the post-acquisition earnings, you need to go back to the analysis of the equity. So we can see that in terms of post-acquisition profits, it is 3.35 lakhs is the post-acquisition earning. So we can consider 3.35 lakhs and 100% of this belongs to the parent. There is no NCI. So this gets added in the retained earnings column. I guess in terms of the stock reserve, we are not given any information. So the additional information does not give me any status in terms of that information. So there is no stock reserve calculations. And dividend received, of course, we need to eliminate. The parent company got a 2 lakh dividends from the subsidiary. You need to eliminate the same. And we can get the figure of other reserves and the retained earnings. And by the way, you also need to represent the capital reserve as a part of the other equity in the balance sheet. So you can say that we're going to get 3 inputs in the balance sheet. One is a capital reserve, one is the other reserve, and one is the retained earnings. You can just add up these figures, and this is what is going to appear in the consolidated balance sheet. Because the other equity is going to comprise of other reserves, retained earnings, as well as the capital reserve as well. So let's see the figure. This remains at 24 lakhs. The capital reserve was 18.85 lakhs. And let's take the retained earnings, 5.72, 3.35 minus 2. That's, I think, 7.07 lakhs. So let's add all these 3 figures. 18.85, 24, and 7.07. I think it comes to 49.92 lakhs is the total other equity to be presented in the consolidated balance sheet. Wow. Now, once we're done with this particular figure, now we are in a position to make the consolidated balance sheet in this case. So let's now go to the consolidated balance sheet and let's represent the balance sheet step number 6. So let's make the consolidated balance sheet in step number 6, applying the rules in this particular case. So suddenly you can see that there is a massive change in the level of the question from the case 1 and 2. But don't worry, we're going to do another question on this area with the NCI, which will endorse your learnings very well indeed. So let's take it further. Let's go to the consolidated balance sheet. So we're starting with the asset side of the balance sheet. And in terms of the asset side of the balance sheet, I am given the inputs. First of all, we've got the non-current assets. So we've got a property, plant, equipment. And this property, plant, equipment is comprising of a land and building, is comprising of a plant and machinery. Now, very careful as you make the consolidated balance sheet in this case. You need to consider the land and building book value for the parent and the fair value adjustments for the subsidiary with depreciation impacts as well. So land and building is appearing at 15 lakhs for the parent, and the land and building for the subsidiary is being taken at increase of 10 lakh. So it was 18 lakhs for the subsidiary, another 10 lakh increase, but there is no depreciations given. So we've taken the book value plus the fair value increase. So that works out at 15 plus 28 makes it 43 lakhs. Similarly, the plant and machinery for the parent company is appearing at 24 lakhs. Subsidiary company, we took it at 20 lakhs and there was an additional depreciation. So I think let's do one thing. Let's take the book values and reflect the changes in the fair value. So the book value was 13.5. Then there was a fair value increase and additional depreciation. So the fair value increase was 5.75. So the fair value increase was 5.75 and there was an additional depreciation of 0.25 lakhs. So we need to consider the fair value increases and the additional depreciations as well. So this is 13.5 plus 5.75 minus 0.25 and 24. This is also coming to 43 lakhs. So to the book value, we took the fair value changes and the additional depreciations. Okay, so PPE is done. Then there was no goodwill. It was a capital reserve taken care. Investments will not appear in the balance sheet. Then we've got the current assets in which we've got inventory. And in terms of the inventory, I am given the inventory of the parent company is 12 lakhs and subsidiary. We need to consider the fair value change, if any. So the book value is 3.64 lakhs and the fair value increase in the inventory is 1.5 lakh. So to the book value of the subsidiary, the fair value changes is being added. So 3.64 plus 1.5 plus 12, that is 17.14 lakhs. Next item in the asset side of the balance sheet is a trade receivable. And then there is a cash. The trade receivable is 5.98 lakhs for the parent company. And for the subsidiary, there is no fair value increase. So we consider only the book value for. So that comes to 9.98 lakhs. No intercompany owings, no stock reserves, a very safe question indeed. Then cash we are given, it's 1.45 lakhs. And the subsidy is 0.8 lakhs. So this is going to be 1.45 plus 0.8, that's 2.25 lakhs. I guess the asset side of the balance sheet is done. So everything is taken care on the asset side with the fair value changes. Let's see the total of the asset side. So 43 plus 43 plus 17.14, 9.98 and 2.25, that's 115.37 lakhs. Okay, so this is on the asset side of the balance sheet. Now we need to concentrate on the equity and the liability side of the balance sheet as well. So let's go to the equity and the liability side. So let's consider first of all the equity. We got to consider the share capital. And share capital, we know we're going to consider only the parent company's share capital. And that is appearing in the balance sheet to the extent of 50 lakhs. Then I think least we forget, we take this other equity, which you've already taken in step number 5. So we got the figure in step number 5, and I think that was appearing at 49.92 lakhs is the other equity. And least we forget, we need to consider NCI, though there is no NCI in this case, so that becomes nil. Okay, so I think equity is done. And then we go on to the liability side. And I guess on the liabilities, I am given there is a bank OD and a trade payable. Just current liabilities are given. So bank OD and a trades payable. So the bank OD is appearing at just 8 lakhs for the parent. There is nothing for the subsidiary. No bank OD is given for the subsidiary. And trades payable, again, we need to consider the fair value adjustments again. And in terms of the trades payable, the parent company is 4.71 lakhs. The subsidiary company book value is 1.74 lakhs. And there is a fair value increase. And that is to the extent of 1 lakh. So that will give me the trades payable as well. Let's see the inputs. So 4.71 plus 1.74 plus 1, that comes to 7.45 lakhs is the trade payable. So this should now hopefully tally my balance sheet as well. Let's see if the balance sheet is agreed. So 50 plus 49.92, 8 and 7.45. Wow, the balance sheet is agreed at 115.37 lakhs. I know it's a cumbersome process, but it's not at all difficult. If you go on a very systematic levels, I think the only critical points involved is in terms of the step number 2B, step number 2A. Where you need to do the analysis of other equity, and I've given you that there are 3 focus points. Step 1 is not going to pose any challenge. Step number 2A is going to pose a challenge. When you need to do the analysis of equity, you got to be careful that there are 3 focus points. Analysis of the other equity would focus on the balance sheet of the subsidiary, the fair value adjustments, and the stock reserves, if any. Then I think step number 3 and 4 is again not a challenge. Getting the NCI and goodwill is not a big deal. Step number 5, I think a few things, what is a focus point at this stage? We just added 1 or 2 elements because this is what I already gave you earlier. And I said you need to consider the post-acquisition earnings and you need to eliminate the stock reserve, which relates to downstream transaction. The only new element we have added is that if the parent received any dividend from the subsidiary, it's not income from the group point of view, which needs to be eliminated. And thereafter, you present the consolidated balance sheet absolutely in a similar manner. I think now it's a good time to ask you your comfort zones at this stage. So if you were to give yourself a comfort zone on a scale of 10, I guess this question might have been a bit scary. Your comfort zones earlier, when I did the questions on case 1 and case 2, must have been a 10 out of 10. Now, this kind of question would have triggered some kind of complexities, and that score of a 10 must have come down to almost like a 7, 8, at least, I guess. Let's see if there are any questions coming in so far at this stage. Okay, I think no questions so far at this stage. That was quite a scary question indeed. Okay, now I want to do another question with you, but I think we should first give you a break, I guess, so that we get a complete hang of things. The only difference is that it is the same question along with the concept of, you can say, NCR. Now, okay, let's take your call. You want me to do a question on a case 4, or you want me to do a question on a chain holding? Because case 1 and 2 and 3 is done. The only difference in terms of the case number 4 and 3 is the presence of the NCI. Rest, everything is same. You want me to do a question, give your inputs in the break on that. You want me to do a question related to the aspect where we do case 4, or you want me to take you to the chain holding instead? Because after that, we've got more elements to do. We've got to discuss the changes in ownership as well. And tomorrow, of course, I hope I give you the announcement as well that instead of the class on Tuesday, we will meet tomorrow itself. So the Tuesday class is got to preponed and it's going to happen tomorrow itself. So send me your input, friends, on that. And I think Koshki tells me a chain holding. Okay, that sounds good. So I think we'll do a question of chain holding after the break. So let's give you a 10, 12 minutes break, friends. And we're going to join you. It's almost around 8:42, 8:43. So let's join you in a 12 minutes time. Enjoy your Welcome back, friends. So I guess you relax your mind in the break as well. And I think I got a couple of inputs. Yes, we would like to do chain holding right now. Okay. So I think let's now take you to a question on how consolidation is done in terms of a chain holding. So that's also one of the very popular kind of questions in the exam. And I guess let's take you on that question. So I've added one of the examination questions which came on a chain holding. So I think let's have a look at that. This is question number 20th. I put it as a case number 5 because case 4 is NCI part. No, not this one. It is the other one. Yes, case number 6, I put it as a chain holding. So let me just read the question to you on a chain holding. So let's have a read first of all. So this is one of the examination questions on a chain holding. Let's read what is given. It says prepare the consolidated balance sheet on March 2018 for a group of companies comprising of Usha, Nisha as well as Sandhya, and the balance sheets are given. And let's take it further. And after the balance sheets are given, let's have a look at the information further. It's a November 18 examination question. It came for 16 marks in the exam. Okay, so after the balance sheet is given to us, we are given something more in the additional information. It says Usha has got 80% shares in Nisha, and Nisha has got 75% shares in Sandhya. So we can see a kind of a chain which is coming in that Usha has got 80% in Nisha and Nisha got 75%, and the holdings are acquired on 30th September 17. The balance sheet is given on 31st March 18. The business activities of all the companies are not seasonal in nature, and therefore you can assume that the profits are earned evenly throughout the year. So wherever we require to divide the profits in a time ratio, we will be able to do it easily on the logic that profits are earned uniformly throughout the year. Then he says on 1st April, the balances in the books of Nisha and Sandhya is given. The position of the reserves and the retained earnings, which is the other equity, is given in the balance sheet. And then he adds on, after giving you the status of the reserves and retained earning, 5 lakhs is included in the inventory of Nisha. And this is an inventory which is purchased from Sandhya. So which means it seems to be an upstream transaction where Sandhya made a sale to its parent company, that is Nisha. Then he says the parent company adopted a policy to measure the NCI at a fair value, and for this purpose assumed that the market price of Nisha and Sandhya are same as the face value. So the face values and the fair values are going to be considered as equal. So we are taking the NCI at a fair value in this case. I think the point number 6 you can cut down. It's not really relevant. So then it says analysis of profits and notes to accounts will form part of your answer. So this is a November 18 examination question for 16 marks. Now, as I'm going to do this question on a chain holding, there are a few points which would also require a logic explanation as well. So in one of the areas, I will first give you the technique, what you need to do, and then we'll explain you at length in terms of the logic as well. But I think explaining this simultaneously could be a bit challenge. So I will give you that this is what you need to do, and then I'll also give you the logic. So don't worry, the logics will definitely come in. Okay, so I think let's begin with this question. So we are looking at the question number 21. So let me start solving the question with you. Question number 21. So the only thing in chain holding is that now since we've got, indirectly 2 subsidiaries, so your workload increases to double the efforts because you need to do 2 analysis of other equity. You got to calculate 2 NCIs. You need to calculate 2 goodwills because there are 2 subsidiaries. And then you need to aggregate, the 2 subsidiaries along with the parent company. So slightly the workload goes up. But I think considering that the technical adjustments are not there, it may not be a time-consuming process. It would take us almost around 40-45 minutes to do this question because we're explaining it as well. In the examination, I think it should take you almost like 30 to 35 minutes, depending upon your speed levels. So let's begin the journey. Let me just open the question in front of me. You can also keep your question in front of you and we can start doing it. Okay, so let's begin the journey. And just give me a second. Let me just organize the question in front of me. Okay, so I've opened up the question and let's begin the journey in this case. So it was answer to question number 21, I guess. So the focus in this case is a chain holding. So let's see how we are going to do the question on a chain holding. The steps remains exactly the same with a little variations. So let's go to the step number 1, first of all, where you're going to identify the acquisition dates and the percentages. Okay. Now, very clearly, you are given in point number 1 in the additional information, Usha got 80% shares in Nisha. So Usha has got shares in Nisha, and it says it has got an 80% stake. And then it says Nisha has got 75% shares in Sandhya. So we are given that Nisha has got shares in Sandhya, that is 75% shares, and the date of acquisition is very clearly given. It says all the holdings are acquired on 30th September 17. So this, as well as the second acquisition, everything happened on 30th September 17. Now, when you see a chain holding, there is a little special thing to be done in terms of the step number 1 as well. Because now you are going to do a consolidation from the point of view of Usha. So we need to see that Usha share in the bottom company. So I would say this is like a top company, this is like a middle company, and this is a bottom company. So we need to see that what is the effective share which Usha has got in terms of Sandhya. Because we are doing the consolidation from the top company point of view, that is Usha. So we need to consider that through its subsidiary, what is the effective percentage it has in the subsidiary. So we can say that he's got 80% of 75%. So we can say 80 into 75. His effective holding is supposed to be 80% of 75. So that works out at a 60%, that is, you can say, through subsidiary. So we can say Usha has got an 80% stake in Nisha, 1, and Usha through its subsidiary Nisha has got a 60% effective share in Sandhya. So this is one thing which you need to do in terms of a chain holding. Look at the perception of the top company and see what is the percentage stake it has got in the middle company, 80, and what is there in the bottom company, which is indirectly through a subsidiary, so 80% of 75. Which also implies that the NCI is supposed to be 40% in this case, not 25, but the NCI will be considered as 40%. So this is one special agenda, what you need to do in terms of step 1. Okay, then let's go to the step number 2. Here again, I need to do the step number 2A, where I need to go for the analysis of other equity. And since we are making a consolidated balance sheet, which is later, the date of acquisition is 30th September 17, and the balance sheet is on 31st March 18. So it is at a later date. So analysis of other equity is certainly required. But now you need to do 2 analysis in this case. So let me organize the information. Let me just organize the data in terms of analysis of equity. So one hand, I'm going to keep Nisha, and the other hand, Sandhya, and let's create a particular column. I think the space might be a little less. Let's take a larger space. So let me just make a special columns. So I'm going to do the analysis of both the companies. So let's create a bit of spacing. So I am considering a column for particulars and pre and post, as we did earlier. So a column for particulars, then a pre and post. Let's get it very clear. So I am looking in terms of the step number 2A. And we're looking at the analysis of other equity in terms of Nisha as well as in terms of Sandhya. So they are both subsidiaries of Usha. So you need to take care of two separate analyses. Let's take a column for particulars. Then this is pre-acquisition and post-acquisition, a column for particulars, a pre-acquisition and a post-acquisition. So we're going to go systematically step by step. Let's define this. This is pre-30th September 17. And I would say anything from 1st October 17 till March 18 is post. And here again, this is pre-30th September 17 is pre. And from 1st October 17 till March 18 is post. Okay. So now remember the three focus points which I gave you for the analysis of equity. You got to concentrate in the balance sheet of the subsidiary other equity. You got to consider any fair value adjustments. I think fortunately, unfortunately, I am not given any fair value adjustments. I need to watch out for stock reserves. Yes, I am given a stock reserve and which is upstream in nature. So get your focus clear in terms of analysis of equity, balance sheet of the subsidiary, fair value adjustments, and any kind of upstream stock reserve transaction. Let's begin first of all with Nisha. We're going to concentrate on Nisha. Now, if you look at the balance sheet of Nisha, we are given as a part of the other equity, there is a reserve and there is a retained earnings. So let's begin with the reserves. And I am going to create a time scale as we said earlier. So this is going to be 1st April 17 and ending on March 18. And the date of acquisition is supposed to be 1st October, middle of the year. So get the time scale clear. So balance at the beginning, which is 1st April 17. So we're looking at 1st April 17 and March 18 is the balance sheet date and 1st October is the date of acquisition. Let's get the status. Now, if you look at the balance sheet of Nisha, the figures of reserve is appearing to the extent of 50 lakhs. And if you look at the balance sheet, the additional information, the reserves of Nisha on 1st April is given to me, it is 40 lakhs. So we can clearly see that there has been an increase of 10 lakhs during the current year. So we can say 40 lakhs is supposed to be pre-acquisition. And we can say that this increase of 10 lakh will be in the time ratio. 6 months is pre and 6 months is post. So this can be divided in the time ratio. 10 lakhs can be divided in the ratio of 1:1. So that takes care of the analysis of reserve. Simple. Similarly, we're going to go to the analysis of the retained earnings as well. So let's take the retained earnings, get the time scale. So this is the balance at the beginning, 1st April 17, and this is March 18, and date of acquisition is 1st October. Okay, now in this particular case, again, we are going to consider the retained earnings on the balance sheet date is given to me, it's 25 lakhs. And if you look at the additional information, the retained earnings of Nisha is supposed to be 10 lakh. So this is the retained earnings at the beginning. Fortunately, unfortunately, no dividends information is given. So I think we are very safe indeed. So I can say that 10 lakh is the figure which is still available on the balance sheet date. So we can compare this 10 and 25 and get the increase during the year. So 10 lakhs is undoubtedly pre in nature. And we can say the increase of 15 lakhs can be divided in the time ratio. Now you can do something extra at this stage. And I think it should be done. Since there is going to be a line by line addition of every asset and liability, why not in terms of other equity as well? So the better thing one can do at this stage is that you can create a separate column for reserves in the post acquisition and a separate column for retained earnings as well, so that you can get the post acquisition figure for the reserve separately post-acquisition figure for the retained earnings separately, and then you can do a line-to-line addition in terms of step number 5. So I think that's preferable, that when you go to consider the analysis of other equity, so not in the pre-acquisition, but in the post-acquisition column, get the different components of other equity as a separate column so that a line-to-line addition can take place. Okay. So we can say this 15 lakhs will be divided in the time ratio. So 7.5 lakhs becomes pre, and here 7.5 lakh becomes post in nature. So I think my first block is done. I've taken care of the other equity in the subsidies balance sheet. No fair value adjustments given. Any stock reserves for Nisha? No. In point number 4 in the additional information, I am given that inventory of Nisha includes something he purchased from Sandhya. So Sandhya made a profit on the deal, and you got to eliminate that from the analysis of Sandhya. So we're going to take care of the stock reserve in Sandhya's analysis. So this is, I think, taken care. Let's get the status of the pre and the post acquisition figures. So this works out at 5 lakhs, and this is 7.5 lakhs. And this is coming to 40 plus 5 plus 10 plus 7.5. So this is working out at 62.5. I don't think so that there would be much challenges in terms of analysis of this equity. I think it was pretty straightforward, though it's a chain holding, but the technique for analysis 100% is the same. Let me still see if there are any concerns, any questions coming in. And of course, you said this was a compulsory question in the exam. Yes, you rightly guessed. It was a compulsory question. So generally, you invariably get questions on consolidation, though it was not there in the last attempt. Chances seems to be good. Let's see. Okay, so this takes care of the analysis of Nisha. Now we are going to go to the analysis of the Sandhya company in a similar manner. So let's consider the balance sheet, and let's consider the reserves, and let's create a time scale again. So we're going to consider 1st April and 31st March, and 1st October in the middle is acquisition date. If you look at the balance sheet of Sandhya, the reserves appearing in the balance sheet is 40 lakhs. And you are given in the additional information, the reserves of Sandhya on 1st April is 30 lakhs, and there has been no other movements which are given. So we can say 30 lakhs on acquisition date is certainly pre. And this increase of 10 lakhs again is going to be divided in the time ratio. So 10 lakhs in the time ratio, that is 5 lakhs each. Let's create a separate column for reserve, and let's create a separate column for retained earnings so that a line-to-line addition can be done. So maintaining that parity, that in the post-acquisition, we get the bifurcations as well. Okay, and then let's move on to the next item. That is retained earnings in the balance sheet. Get the time scale again, 1st April and 31st March, and we're looking at 1st October. Pretty simple. So if you go back to the balance sheet of Sandhya, we are given the retained earnings is appearing at 30 lakhs. And if you look at the additional information, the retained earnings is appearing in the additional information at 15 lakhs at the beginning of the year. Fortunately, unfortunately, again, no dividends are there. So I guess we can directly compare and get the increase of 15 lakhs in this case. So we can say 15 lakhs undoubtedly is pre, and this increase is again in the time ratio. So that's 7.5, and that is 7.5. Increase of 15 lakhs divided in the time ratio. Block 1 is done. We're taken care of the analysis of the other equity. Fair value adjustments are not there, but now we need to go to the stock reserve. So we need to consider the stock reserve, which is a part of the upstream transaction. So let's consider the elimination. And unless mentioned otherwise, we'll always assume that this stock sale took place in the post-acquisition period. So this elimination of the unrealized profits is going to be done out of the post-acquisition earning. So the question is silent with regard to when the sale took place. We're going to comfortably consider that it took place in the post-acquisition period. Otherwise, the elimination will have to be done out of the pre-acquisition period if the sale was done in a pre-acquisition period. So if you go to the point number 4, regarding the stock sale, 5 lakh inventory is included and it was purchased at cost plus 25%. So cost plus 25% would mean it is 1/4 on cost and it is 1/5 on sale. So we can say on the inventory of 5 lakh rupees, the profit is 1/4 on cost and it is 1/5 on sale. So you got to eliminate this 1 lakh rupee out of the post-acquisition retained earnings column. I guess that's it. There is nothing else which is further given. So I think my analysis of the equity is done. Let's get the figures out here as well. So let's see what is the pre and the post-acquisition. So this is 30 plus 5 plus 15 plus 7.5. That works out at 57.5. And this is coming to 5 lakhs and this is coming to 6.5 lakhs. That is RE. Right. So I don't think so there would be any challenge in terms of doing this analysis of other equity. But the step number 2 is not over. You now need to calculate the net assets on the acquisition date in step number 2B. The critical portions yet to come. This is easy. Okay, so let's do now step number 2B. So we go on to the step number 2B. And in this case, step number 2B, I need to get the net assets, of course, at a fair value on date of acquisition, though there are no fair value adjustments. So we need to basically take the sum total of the share capital. We need to consider the sum total of the share capital plus the pre-acquisition profits, which we've got in the analysis. So we just need to consider the sum total of the pre-acquisition profits and the share capital. Now, this exercise is again got to be done for both the companies. We need to do this for Nisha and we need to do this for Sandhya as well. So let's do the calculations for both the companies. So we need to calculate this for Nisha and we also need to calculate this for Sandhya. So we'll take the sum total of the share capital and the pre-acquisition profits and get the status of the net assets in this case. So let's pick up the share capital in the balance sheet. The share capital of Nisha is appearing, okay, to the extent of 200 lakhs. And Sandhya is appearing to the extent of 160 lakhs. And the pre-acquisition profits you've already computed in the analysis, 62.5 and 57.5. So this is 62.5 and this is 57.5. So this works out at 262.5 lakhs. And I think this works out at 217. So 160 plus 57, yes, it is 217.5 lakhs. That is the net assets on the acquisition date at a fair value. Okay, so this is done. Now comes the step number 3 and the step number 4. Now I'm going to tell you what is to be done. Then I will tell you the logic of why is it so done. So the next 5-10 minutes is going to be crucial. It's going to put a bit pressure on your mind because this is something which you're going to find only in terms of chain holding. So watch me carefully. Let's do the step. I think let's do one thing. Let's create a separate page because I want to do now the calculations of the NCI and the goodwill, step 3 and 4 a bit simultaneously. So let me go to the step number 3, which is the calculation of the NCI. And let me also organize my step number 4, which is the calculation of the goodwill or the bargain purchase gain, that is capital reserve. Now we need to do again 2 calculations, NCI in terms of Nisha and Sandhya, goodwill or bargain purchase gain in terms of Nisha and Sandhya. So let's organize the data. So let me organize the data. So we're going to take the columns for particulars. Then we'll take Nisha and Sandhya. Here again, let's take the columns for particulars and get Nisha and Sandhya, and let's organize the data. So let's take the column for particulars. Then this is Nisha, and then this is Sandhya. Then this is again particulars, and this is Nisha, and this is Sandhya. Okay, now watch this carefully. I'm just going to slightly tone down the speed once again. This was a little faster calculations done so far. Let me just little tone down the speed and watch me carefully in terms of the calculation. So let me just note down the figures, the data, then we'll get the figures. So in terms of NCI, we are very clearly given that NCI on the date of acquisition is to be taken at a fair value approach as per the instructions in the question. And then what you need to do, you need to add the share in post-acquisition profits. You need to add the share in the post-acquisition profits as well. So this is what we need to do in terms of NCI. We need the NCI at acquisition date, and then you need to add the share in the post-acquisition earnings. In terms of goodwill, you'll take a PC, you add the NCI, which is on the date of acquisition, mind you. It is the NCI at the date of acquisition, mind you, not the total NCI. And you compare the sum total and you compare this with the net assets at a fair value, and you're going to get the amount of goodwill or a capital reserve. Okay, now watch me carefully. Let's begin with the calculations of the NCI with some information which is given in the additional information clearly. Look at the point number 5 in the additional information, and it clearly says the parent company adopted the accounting policy to take the NCI at a fair value, that is at a quoted market price using Ind AS 103. Assume that the market price of Nisha and Sandhya is same as the face value, which means we are considering that the face value of the share capital is equal to the fair value of the share capital. So if you need the NCI, let's look at the balance sheet of Nisha. Share capital is appearing to the extent of 200. And what is the NCI in terms of Nisha? I guess let me take you back on the first step itself and get the NCIs clear. Can I say in terms of Nisha, it is 20%, but in terms of Sandhya, it is 40%. So 20% for Nisha and 40% for Sandhya. So let's come back to the agenda. So we need to consider that there is a 20% for Nisha and there is a 40% for Sandhya. So on the share capital, we take 20%. This is the face value equal to the fair value. So 20% becomes NCI. Sandhya, we are given the figure is 160 and we consider 40% in terms of NCI. So this is 40 and this is supposed to be 64. Okay, so the NCI on the date of acquisition is done. So let me also do another thing at this particular stage. We can comfortably consider these figures and we can take it out here, because we'll need the NCI for the purpose of goodwill calculations on the acquisition date. So let me fit up the figures out here. It is 40 as well as 64. Okay, now let's see the share in the post-acquisition earnings. And for this, we go back to the analysis of the equity. Can I see in terms of Nisha, we've got 5 lakhs and 7.5. That is 12.5, and this is 5 and 6.5, 11.5. The post-acquisition profits is 12.5 and 11.5. So let's add the post-acquisition increase. So in terms of Nisha, it is 12.5, and this is into 20%, and this is 11.5 into 40%. That is the share in the post-acquisition earnings. Sum total of the reserves and the retained earnings put together. So we've taken the post-acquisition increase in step number 2A, and we've got the stake of the NCI. So 12.5 into 20%, that's 2.5. And this is 11.5 into 40%, that is 4.6. I think there should not be any challenge so far. I guess at this stage, I think everything is pretty simple and straight indeed. So what we've done so far in this particular case, we've just organized the NCI on the acquisition dates, and we've taken the share in the post-acquisition earnings based on the analysis. Okay. Now, we're not closing the NCI at this stage. There is something more to be done. We'll take care of that something more. Now, let's come back to the balance sheet and let's have a look in terms of the purchase consideration. So we need the PC. Now, very careful. The purchase consideration is nothing but it is the investment which appears in the balance sheet of, you can say, Usha and Nisha. So if you look at the investment appearing in the balance sheet of Usha, it is 170 lakhs. And if you look at the investment in the balance sheet of Nisha, it is appearing at 140 lakhs. But. Now watch me carefully. The critical point comes out here. I'll give you the logic later, some logic out here, some logic later, but first get it very clear what you need to do. If you look at the calculations of Sandhya, I'll just like to take you back out here. Let's go back to the step number 1 and have a look out here. So let's go to step number 1. We can see that Nisha got a 75% stake in this company. Nisha got a 75% stake in this company, and this was at a consideration that is 140 lakhs. He bought this investment at 140 lakhs. So this 140 lakhs is the consideration which is paid for 75% stake. But I am doing the question based on that Usha has got a 60% stake. That means 80% of this is funded by Usha, because Nisha, 80% shares are with Usha. Hear me carefully. We can say that in terms of Nisha, 80% shares are with Usha and 20% is with the NCI. So whatever money he is funded, 80% of this is funded by Usha. 20% of this is funded by NCI. I put it again. When Nisha is investing a total of 140 lakhs in Sandhya, you can say this company, 80% is funded by Usha. He is the 80% owner and 20% NCI. So we can say 80% of this is funded by Nisha. And we can say 20% of this is funded by NCI. So we can say Usha funded only 80% of this money and 20% is funded by NCI. So what we're going to do, when you go to calculate the amount of goodwill, we will not consider 140 lakhs as the investment. But what you need to consider in this case is 80%, because everything is being seen from the point of view of Usha. We are doing all the calculations that Usha has got 2 subsidiaries, Nisha as well as Sandhya. And he has got a 60% stake in the company. So this is the cost of 75% and 80% of that is funded by Usha. So you need to consider only 80% in this calculation. Therefore, the question arises, where does that remaining 20% go? Now, if I tell you that 20% is going to be reduced out of this figure, out of the NCI, you're going to reduce the 28. You will say, sir, why? Don't worry, I'll give you the logic also very soon. As I said, some logic given. Why we are considering 80%, I've already explained, but then the remaining 20% has to go somewhere. So we have taken the 20% as a reduction from NCI. Now you would say, why? Don't worry, let me close the calculations, then I'll explain in detail that why 20% of this is being reduced from the NCI. No worries, I'm going to do that. So let me just close the calculations now. We get the NCI, and you need to compare it with the net assets to calculate the amount of goodwill or bargain purchase gain. So this is coming to 68.6. And this is coming to 42.5 minus 28. It is 14.5. So if you just want to add the NCI for the balance sheet perspective, it is coming to 83.1. So we're getting a total NCI, which is to the extent of 83.1 for the purpose of console. Let's now take the net assets as well. This is 262.5. This is 262.5. And this is 217.5. Right. So let's see what is the figure. This is 210 and this is 204. So we are getting a capital reserve in this case as well. The net assets is greater. So this comes to 52.5 capital reserve, and this works out, I guess, at 13.5. So let's add this for the balance sheet perspective. 52.5 and 13.5. So we're getting a total figure which is supposed to be 66. Okay. So this is done. Let me just, I think, quickly. Sorry. I think I did a mistake. I didn't take that 80%. It's not 204. I'm afraid we need to change the figure. This is 80%. 140 into 80% is 112. And this works out at 176. And this works out at 41.5. And this sum total is 94 from the consolidated balance sheet perspective. Okay. Okay, now I think we need to explain you the logic. Then don't worry, we'll take a quick view in terms of what are the critical points in a chain holding. So I think let's do one thing before we go back. Let's look at the criticalities which are involved in terms of a chain holding. Focus points now. Now let's have a look at the focus points in terms of chain holding. Step number one, you need to look at the effective percentage which a top company has in the bottom company. So your first focus point is to look at the effective percentage the top company gets in the bottom company, so that you can identify that the NCI is not 25%, but it is 40%. Focus one. There is nothing special in terms of step number 2A. There is nothing special in terms of the step number 2B. But there is something special in terms of the step number 3 and 4. So in terms of the chain holding, you need to remember now everything is being computed from the point of view of the top company. So when you consider the investment, we know that 80% of this is funded by the top company and 20% is funded by the NCI. So we're taking only 80% in this calculations, and the remaining 20% is reduced from Nisha. Why did we reduce it from Nisha? We now going to explain the logic, but this is one more thing to be kept in mind. Let's, I think, now explain the logic to you. Let me see if any questions coming in. No so far. Okay. Today, in any case, I think the criticalities are being discussed at length, so I don't see much questions coming in, but you need to definitely revise things. Now, let's understand the logic, friends. Why did I reduce the 20% investment from the NCI of Nisha? I need to take you back, friends, on the area. And if you recall, in the previous class, I had given you that investment is replaced by the share in the net assets and the goodwill. If you remember, last class, I very clearly give you that what is a consolidation. You replace the investment, aggregate all the assets and liability, represent the NCI and the goodwill. Now, let's have a look. Was this very carefully, you're going to get the logic in this case. So let's say this is the separate financial statements of the holding company. So let's consider this is the separate financial statements of the holding company. Now see, if I look at the investments, there are two investments appearing in the balance sheet. So one is the investment which is done in Nisha, and one is the investment which is done in Sandhya. So these are the two investments appearing in the balance sheet of both the parents put together. So one is appearing at 170 lakhs and one is appearing to the extent of 140 lakhs. So this is the status of the investments in the balance sheet. Now, let's understand one thing very carefully. This investment, now watch this very carefully, you'll get the logic. This investment is going to be replaced by what? This is going to be replaced by what? It is going to be replaced by, number one, the net assets, 100%. and it is going to be replaced by NCI, and it is going to be replaced by goodwill, right? This is what I told you in the previous class as well, that consolidation means removal of the investment, and what takes place is the aggregation of assets and liability full, and then the NCI and the goodwill. Okay, now let's go one by one. Can I say in terms of Nisha? In terms of Nisha, I'm going to eliminate this 170 and a goodwill will come. I will also add the net assets of Nisha. I will add the net assets of Nisha. And in this particular case, I will also represent the NCI of Nisha. So there is no problem as far as Nisha is concerned. You eliminate this investment, and what takes place is the goodwill, and what takes place is the 100% net assets and the NCI. So Nisha is not a problem. Nisha is not a problem. Usual calculations done in terms of Nisha. Now watch Sandhya. Now, if you watch Sandhya, did you actually remove this investment? No. You removed only 80% of this investment. You removed only 80% of this investment, so the remaining 28 is still there. Because in your calculations, be careful, you are considering only 80% of the investment. So in your calculations, you are only removing 80% investment. If you're removing 80% investment, 28 is not yet eliminated. You represent the goodwill based on that 80%. You take the aggregation of the assets based on that 60% stake, and you also take the NCI of Sandhya as well. Now the question arises, if I do not take care of this 28, you need to show it in the balance sheet to tally the balance sheet. Are you getting the point? If I am taking only 80% of the figure in goodwill calculations, then the remaining 28 continues in the asset side of the balance sheet. Investment. Who made this investment? Who is the company who made this investment? Can I say this investment is made by the NCI of Nisha? Am I right? If you notice, we said that Usha, is got an 80% stake in Nisha, and the remaining 20% is with the NCI. So when Nisha made an investment in Sandhya, 80% of this was funded by Nisha and 20% was funded by the NCI. So you go to show the NCI on one hand, and you will say that this is the investment which NCI has in Sandhya. Right? So you are going to show that this is the NCI of Nisha and this is the NCI's investment in Nisha. So it makes sense that you set it off. It makes sense that you set off the amounts. Instead of showing 28 in the balance sheet with the NCI, why don't you net it off? Because this is what is payable to the NCI indirectly, and this is what the NCI needs to recover. So what we have done, we have taken the 28 reduction from Nisha. Because the 28 is a funding by the NCI of Nisha. So therefore, since in the calculations of goodwill, 80% investments taken, the remaining 20% didn't get removed from the balance sheet in a consolidation process. So you are going to set it off against NCI. Am I clear with the logic, friends, on this? Did you get the entire logic in terms of things? You want me to consolidate this once again, or is this pretty clear? I've given you the logic of why I'm considering 80% here. I'm also giving you that the 20%, why is it getting reduced from the NCI of Nisha? So let me just quickly give you the points once again. When you were doing the calculations of goodwill, you took only 80% of 140 in the goodwill. So your goodwill, net assets, and NCI is everything based on 112. Because in the goodwill calculations, you are removing 112, getting the goodwill, getting the net assets and the NCI. So 28 continues in the balance sheet on the asset side. So on one hand, if you visualize, this 28 is the money which the NCI of Nisha has funded. So you need to basically either continue to show the NCI as it is and show 28 on the asset side, which doesn't make sense. So we need to net them off, and therefore the 28 gets reduced. This is the logic in terms of reduction from the NCI. Okay, so far, so good. So let's come back. Step number 3 is done. And my step number 4 is also, step number 3 and 4 is also done. Okay, now we can go to the step number 5, and then we can make the consolidated balance sheet as well. Wonderful indeed. So let's go on to the step number 5 now in this case. So let's go to the step number 5. Step number 5, the focus is to calculate the other equity which is going to appear in the consolidated balance sheet. And you need to make separate calculations again for the working purposes for Nisha as well as Sandhya, because we need the post-acquisition earnings in that case. So in this case, we're going to consider the balance sheet of Usha. So in the balance sheet, we've got reserves and retained earnings. So let's create a separate column for reserves, a separate column for retained earnings, and we're going to consider the picture out here. So when you consider the other equity, there are certain focus points. The holding company's own equity, that's 1. The share in post-acquisition, that's 2. The dividends received from the subsidiary eliminated, it's not an income, and there is stock reserve, which is supposed to be downstream. I don't have dividends. I don't have any stock reserve, which is downstream. So the only thing to be taken care is the post-acquisition earnings. So we're going to consider holding company's own other equity. So the own other equity of Usha is to the extent of 90 and 80 lakhs. And to this, we can add the share of holding in subsidiary post-acquisition earnings. So we're going to do this for Usha and Nisha, and we're going to do this for Usha and Sandhya. So we need to consider Usha and Nisha as well as Usha and Sandhya, the 2 shares. Let's go back. So let's look at the analysis of the equity. So if I go back to the step number 2A, now we know that Nisha has got 5 and 7.5 reserve and RE, and he's got 5 and 6.5 in RE. So let's go to the calculations. So in terms of reserve, it is 5 into 80%, and here it is 5 into 60%. Remember, the stake here is 60%. Here it is 7.5 into 80%, and here it is 6.5 into 60%. We need to consider the share in the post-acquisition reserves and in terms of RE. Okay, I think the figure got a little messed up. This is not 5 and all. We just need to slightly change the figures. Reserves was 5, and this is, let me change it. So this is 5 into 80, and this is 5 into 60. This is RE is 7.5 into 80, and this is 6.5 into 60. So we got to consider a 60% in case of Sandhya. So 80% of the parent for Nisha, 60% for the parent in terms of Sandhya. Done. So this gives me the calculations, and I think we're getting a capital reserve. We'll just add the figure of capital reserve also, so that we can get the sum total of what is the other equity in the consolidated balance sheet. So let's have a look out here. So we've got 5 into 80% is 4. So 4 plus 3 plus 90, that's 97. And this is going to be 7.5 into 80%, 6. And this is 3.9, so I think this is 89.9. And I guess capital reserve was appearing to the extent of 94. So we've got 94 is the capital reserve. Let's add up all 3. So 89.9, 97, 94. This is, I think, coming to 280.9. This is the total other equity in the consolidated balance sheet as well. Wow. So now we are in a final position in terms of making a consolidated balance sheet as well. So let's now make a consolidated balance sheet in this particular case. So let's begin with the asset side of the balance sheet. Wow, that's interesting. Your focus needs to be maintained. Otherwise, I think it's not a very difficult job indeed doing consolidations. But yes, of course, the challenges comes in, if you've got some calculations involving deferred tax and all, that can be a bit exciting and challenging as well. Okay, so let's begin with the asset side of the balance sheet. And on the asset side, let's start with the non-current assets. So we've got, first of all, the tangible assets. I'll call it as a PPE. No fair value adjustments are given. Just add the three companies. 160 plus 180 plus 150. So this is the property, plant, equipment for all three put together. So 160, 180, 150, that works out at 490. There is no goodwill. We had a bargain purchase gains, so no worry. Investments won't appear. And then we've got the current assets. In the current assets, we've got the cash in hand, cash and the cash equivalents. So that is going to be 114. And that's 20 plus 20, that works out at 154. Then there is a bill receivable and a trade receivable. So let's take the bill receivable and the trade receivable. So in terms of the bill receivable, it is 36 plus 15. So that works out at, I guess, 51. Then there is a trade receivable, 130 plus 50. 130 plus 50 plus 110. That's the trade receivables. So that is 130, 50, and 110. That's 290. And then we are given the inventories. And I guess in terms of inventory, I need to consider the stock reserve elimination as well. Though it was an upstream transaction, but we need to take care of that unrealized profit of 1 lakh. So this is 11035, 11035 plus 25 minus the stock reserve, that is 1. So 145 plus 25, this is 169. This is on the asset side of the balance sheet. So this is 490 plus 154, 51, 290, 169. I think it's coming to 1154. So this is as far as the asset side of the balance sheet is concerned. Now let's focus on the liability side as well. So let's go on to the liability side of the balance sheet in this case. Let me see if everything is going well. I guess, yes, the figures are perfectly okay. Okay, there is, I think, an adjustment for a bill of exchange as well, is it? Yes, we can see in terms of bills payable, some intercompany owings. So I think I'll have to slightly change the bill receivable, because on the liability side, we can see that there is an intercompany elimination. The bills payable on the liability side from the intercompany owings is 35 and 15. So we need to eliminate that 35 and 15. So this is going to be 1. We'll eliminate the common debtors, creditors, bill receivable, bills payable. So 490 plus 154, 291, 169, that's 1104. Okay, I think now it seems to be correct. Okay, so now with this, we go on to the liability side of the balance sheet. So let's consider the figures here only. We got equity and liability. So let's consider, first of all, the share capital. The share capital is going to appear only for the parent company, that is Usha, that is 300. Then we can consider the other equity, what you've already computed at 280.9 in step number 5. And least we forget, we could take the NCI as well. And I guess NCI was 83.1. The NCI was 83.1 computed in step 3. Okay, so equity is done. Then on the liabilities, we just have got trade payable. Bills payable will get cancelled off because of intercompany eliminations. So bills payable will become 0. So trade payable is 235. Then it is 115. And then it is 90 with no intercompany eliminations. So that's 235 plus 115 plus 90, that's 440. And I guess now hopefully my balance sheet should get tallied at this stage. So let's see if the balance sheet is agreed. So 300 plus 280.9 and plus 83.1 plus 440. Wow, the balance sheet is agreed at 1104. The chain holding balance sheet is done. Wow, super. So that was quite an interesting exercise. Now I've done all the varieties of questions in terms of consolidations to you, from the case number 1 to the case number 2 to the case number 3, effectively the case 4 as well, because the only challenge in terms of 4 is the NCI and the concept of chain holding. So we've done the normal questions with you and the chain holding questions, everything is done. But what is important now is you need to do these questions by hand. Sit down, first of all, revise these questions, and then what you need to, you need to go and do these questions by hand, full-fledged. Because trust me, vouching these questions is going to be a pretty easy exercise. The concept comes in when you sit down and do these questions by hand. But there is another small level element which is still pending in terms of the standard. We've covered the Index 110, but there is a small little agenda before we go to the Index 111 with you. And the agenda is in terms of changes in the ownership interest. Now, I would like to just take you a little quick look. I know time is not enough right now, but I think I just want to make a little walkthrough on the chain with you. So what I've basically done, I've just added a few questions, which I would, of course, just give you a basic overview at the moment. We're not doing the questions, but let me just give you, there is one area of discussion further, which is given in the study material, and that is regarding the concept of changes in ownership interest. Now, I have a very interesting technique of solving these questions. I know your mind is heavy. Don't worry. I'm not going to give you the technique right away. But I'll need almost like, I think tomorrow, maybe another 15, 20 minutes, or maximum half an hour's time to give you the inputs in respect of this. Because tomorrow I would be mainly concentrating in terms of Index 111, that is on the joint arrangements, which is again a pretty easy kind of standard. And then after that, we're going to cover the Index 28 with you. Okay. So we can see that when we're looking at the changes in the ownership interest, we can say we can divide entire journey in terms of two cases. One is there is a loss of control. Now, when I say that there is a loss of control, it can be a lot of permutation combinations. It could be a situation which would mean that there is 100% disposal. It could also mean a situation, a loss of control, that from a control you convert to a significant influence. It could also be a situation that from a control you simply become a passive investor. So there are three possibilities which could arise in terms of that the control is lost. You completely sell off the shares, one. You convert from a control to a passive investor, there is Index 109. You convert from a control to a significant influence, there is Index 28. Similarly, there can be a second permutation combination as well, which I put it as the case number 2. So this would mean, okay, I think the first one I said no loss of control. This is, I guess, I've been it the other way around. This is a case where I would say there is a loss of control. Now, coming to the cases when there is no loss of control. So no loss of control would mean that you dispose the shares, but the control continues. So we can say that when I say that there is no loss of control, it can be a disposal where the control still continues. It could also be a further acquisition where you acquired more stake and the control continues. So in case number 1, you can have two situations when you made a disposal, but the percentage went down, but the control continues. Or the percentage further increased. And if I say there is a loss of control, it can be 3 cases. So we can say 2 plus 3, there are 5 cases in all. But I'm going to give you a very simple technique with the help of which you can do these questions in a Rajnikant style. But I think I'm going to give you that inputs not today, how we are going to do any of these questions, whether it is a case, because I'll give you one technique for this kind of cases, I'll give you one technique for that kind of cases, because we need to make a distinction that if there is a loss of control, then the accounting is slightly different. And if there is no loss of control, the accounting is slightly different. So we're going to give you basically two different accountings. When there is no loss of control, one case of accounting for both the cases. And I'll give you another set of accounting when there is a loss of control, how do you tackle those three cases. So you'll be able to easily manage these questions as well. But I'll discuss and give you the intricacies on this tomorrow. And we're also going to start with Index 111 tomorrow. So let me remind you again, friends, that we don't have a class on Tuesday. The class on Tuesday gets preponed for tomorrow. So I'll be joining you back again tomorrow morning at 7 in the morning. Okay, so let's see if there are any questions, friends, coming at your mind today. I think today has been a very less number of questions coming in Sunday, and I think technicality is too high indeed. Okay, so I think there are no questions so far. So I think it's time to bid goodbye, friends, to you. And I'm going to join you back tomorrow morning once again. Thank you very much. Enjoy your weekend and please revise all what we have done. Thank you. Bye-bye and take care.